Hey guys, it's Crossroads here. Now, don't skip ahead just yet. We're going to play a game together. I don't want you to spoil that game. But first, I need to introduce a concept that we're going to talk about today, and it's called climbing the wall of worry. Now, if you've heard of this already, hang with me for just a minute for those that are newer. But it's the idea that in a bull market, that the market tends to shrug off after pullbacks any sort of worry that's out there or fear. This is a chart that kind of illustrates that. We can see things from Ukraine invasion, FTX bankruptcy, Titan submersible implosion, yin carry trade collapse, going all the way back to probably events that you don't recognize and remember. And so it's this idea again that the stock market continues to go up. Not that stocks always go up or all stocks do, but we're going to look at the wall of worry. We're going to see if we should be worried about the current stock market and the state that we're in, and also what to do if you are worried and are concerned. But let's play that game first. And the game that I want to play, which I think will help us understand and illustrate the idea of this wall of worry, is this game right here. So don't skip ahead just yet. But what we're going to do is we're going to look at these events. Now, in blue, these are from 2021. In yellow, this is from 2023. Of course, 2022 is a bear market year, so we're not going for it with that year. But I want to show you these events, and then these are the price moves that happen from peak to trough for each of these. And so what I'd like you to do is go ahead and put in the comments here in just a moment. Now I'm going to explain each of these here right quickly as well. But I want you to do three things. Type what you think is going to be the biggest loser out of these, which one of these actually gained, and which one of these events actually didn't happen at all. So those are the three things, because one of these is not real. So, and you might remember all of these except for hopefully one. Evergrande. Evergrande was, of course, the crisis that was happening in China. A lot of their market revolves around the real estate market, and Evergrande is a company that is very much tied into it and was basically going bankrupt. And so it caused a lot of woes in the market at the time. Ever Given. Yes, that's right. That's the name of the ship that was stuck in the Suez Canal for about a week. And of course, I believe 20% of the world's commerce actually goes through the Suez Canal. And so this was a major concern. J6 riots, in quotes, whether you think they're a riot or not. That's what the headlines were, and that's what, of course, grabbed the attention of the market on that day, where there's a lot of concern over the election and potential riots, whether you call them that or not. Of course, it was something that was very unsettling for a lot of people, including the market. Chinese satellite drift. So this was the event where that Chinese weather satellite actually went off course into U.S. military space. And China initially denied it and said, no, this isn't ours. They said, well, it's just a weather satellite, nothing to be concerned. United States talked about shooting it down. Now, nothing happened, but, the tensions really ratcheted like they tend to do. SVB, this is Silicon Valley Bank collapse. And, of course, it was just one of several, but the biggest and most well-known bank collapse at the time, which, of course, caused a lot of consternation with the stock market. Fitch credit downgrade. This is where the organization Fitch was not the only one that did this, but they downgraded the credit rating of the United States government. As a result, you shouldn't be surprised that the market pulls things back. Hamas and Israel attack. That was the attack from Hamas to Israel. And of course, the market did not like that. Any sort of geopolitics tends to pull things back. And of course, a debt ceiling showdown, where it seemed like perhaps that we would actually default on our debt, that the debt ceiling was not going to be extended. There was some turmoil around that. So go ahead and pause it right here for just a minute. Take a look at these again. Which one of these do you think caused the biggest drop? Which one of these actually saw an increase? And which one of these are fake news? All right. So hopefully you paused it, because I'm going to reveal here what each of these were. So here are the answers. The fake one is the Chinese satellite drift. Now, you might be thinking of 2023's event, which had balloons and weather balloons. Tensions weren't too ratcheted up. We weren't too worried about that. But yeah, this one is absolutely fake. Now, surprisingly, the J6 riots actually saw an increase in 0.6% on the market that day. Now, we can see that Ever Given was, one that only gave a little bit of a pullback, but it was a real event where there was a lot of concern over it, what this would do to the global economy, cost, causing more inflation as well. Evergrande, of course, was quite massive and lasted a good long time. And I don't know if we're fully out of the woods on that one either. Silicon Valley Bank, of course, collapse precipitated the biggest pullback out of all these. And so if you guess Silicon Valley Bank being the biggest loser, you're absolutely correct. Of course, J6 was the biggest gainer in fake news with the Chinese satellite drift. And each of these, Fitch credit downgrade, debt ceiling showdown, there's actually two of them. So if you put, it's 4% or 4.4%, whichever you put here, or the 3.5% drawdown for Hamas and Israel. So why did I show that? Well, how many of those events did you actually remember? And if you remembered them, and hopefully you didn't remember the Chinese satellite drift, but if you remembered them, do you remember them, or do you think of them now as like, oh man, these are existential threats to our economy. These are threats to the market. We're going to see a massive downside. Probably not. Why? Because you don't have the news media pounding at you and saying, these are worrying, terrifying events. Here's all the bad headlines. Here's all the fears and the worries out there. Fear is very contagious, and it's something that you need to be very, very aware of at the time, that what feels like it could be an absolute calamity and disaster and horrible and world ending or market ending at the time, oftentimes in hindsight looks like, not too big a deal. Like, these aren't good things, but certainly they weren't worth the fear that we gave them at the time. And that's very common for not just stock markets as far as a wall of worry, but also human history. Now, there is one of the best investors of all time, Peter Lynch, has some amazing comments to say on this, climbing the wall of worry, and what you should actually think about in terms of macro as well. So I want you to hear his own words from Peter Lynch. This is about 3 minutes. And then we're going to talk about what to do if you are concerned and you're caught up in this worry.
And then I want to conclude with there's always something to worry about. If you own stocks, there's always something to worry about. You can't get away from it. What happens in the 50s, people were worried about the only reason we got out of the Depression was World War II. We got another recession in the early 50s. They said we're going to go right back into a depression. People were worried about a depression in the 50s, and they worried about nuclear war. I mean, back then, the little warheads they had then, they couldn't blow up McLean, West Virginia, or McLean, Virginia, or Charlestown. Now, all these countries that end in STAN, there's 9 of these STAN countries that have come out of Russia. They all have enough warheads to blow the world up, and no one worries about it. When I was a kid, people were building fallout shelters, and we used to have this civil defense drill. Remember this one in high school? You get under your desk. I never thought even then that was a particularly good thing to do. That blow was somebody put a hat, would all get under our desk. But in the 50s, people wouldn't buy stocks, except for the 80s. The 50s was the best decade this century of the stock market. And people wouldn't buy stocks in the 50s because they're worried about nuclear war and they're worried about depression. Then people, remember when oil went from 4 to 40 and it was going to go to 100 and we're going to have a depression? Remember that one? Well, about 3 years later, the same experts, now higher paid, oil's now at 10, they said it was going to go to 4 and we're going to have a depression. And then the Japanese, remember how the Japanese were going to own the world? Remember that one? And then we're going to have a depression. And then about 2 years later, we're all worried about Japan collapsing. And this is the most absurd thing I've ever heard. It's a company with a 20% savings rate, incredible workforce, incredible productivity. And people are saying we're going to have a depression because Japan's going to collapse. And they had, on their prayer list, they loaded Mother Teresa and crippled children, and they were praying for Japan at night. It's unbelievable. I mean, the LDC debt. Remember the LDC debt? Remember that one? All these countries, all Chase had lent their net worth to Brazil, Chile, Peru, and all these other countries, and so and all the other countries. And LD said they were not going to pay it back, and we're going to have a depression. It always ends in we're going to have a depression, or the Great Depression. We're going to have the Great Depression. I never could quite understand that adjective in front of depression, but the Great Depression, or the big one. The big one's coming. But all these countries, and now I understand, these are called then they were called less developed countries. Now, we used to call them underdeveloped countries. Those are all wrong terms. Those are not politically correct. You have to call these emerging countries. You can't use less developed or underdeveloped because that's, in fact, the other day I heard the politically correct term for somebody that's overweight is laterally challenged. That's so there's always something to worry about. And the key organ in your body in the stock market is your stomach. It's not the brain. If you can add 8 and 8 and get reasonably close to 16, that's the only level of math you need to know. You don't know to need the area under the curve. Remember that quadratic equation and an integral calculus and the area under the curve. I mean, whoever kid was under the damn curve. I mean, but you had to study this. You don't need this in the stock market. So All you have to know is you're going to see, it's always going to be scary. There's going to be always something to worry about. And you just have to forget all about it, cut it all out, and own good companies or own turnarounds. Study them and you'll do well. And that's all there is. And I'm ready for questions.
That's it right there, Peter Lynch. He is one of the greatest investors of all time. Well worth a listen, well worth a read if you're not familiar with him. But in essence, he says, you can overthink things as retail. And that's one of the advantages that we have is that usually, hopefully, you're not investing money that's not your own as far as margin, as far as taking on debt. If you do, it's hopefully very little and only what you're able to afford. And if you are not overextended in terms of short-term options and having too much of those, then we have time on our side. If you're not risking money that you don't need in the next 5 years, because the markets tend to climb this wall of worry. Now, we probably are in the middle of a pullback. I expect that there's probably a lot more pullback to be had. I'm not expecting what we had in April, but it wouldn't be shocking if over the next couple of weeks that we continue to bleed a little bit over 2, 3, maybe even 4 weeks. We'll have to see. But it tends to be that these bull markets, they continue to keep going up. And I don't think that this might not even be the high of the year. It could be. That's not the end of the world. But what do you do if you are really concerned, if you are really worried, if you just are thinking about going to sleep tonight and you're worried about your portfolio after a little pullback like this? It's probably time to take some off the table. Now, if you have massive, massive gains, you might want to take some money off the table and just say, you know what, I'm going to realize some of these gains. I don't want all of them to get away from me, especially if you're up 100%, 200%, 300% over the last few years. You've not taken gains. It's okay to do that. Nobody has gone broke by taking gains. Now, you can let things ride too, but I'm just saying, if you are having a trouble sleeping at night, do what helps you sleep at night. So manage your risk too. Beyond just taking gains, manage your risk. You might have gone wide, which there are times to go wide and to invest in maybe not as stable and high quality of companies, but near the market top is usually not the best time to do that, especially if you're doing a lot of money on that rather than small speculative bets. Now, myself, I've gotten out of all my swings. I had a max loss that I was okay with taking, and I got out. So Lululemon, I got out at 218. That's a lot lower than that today, sadly. I still do think that company will turn around. But Peter Lynch there said, invest in turnarounds. If you think that there's a legitimate turnaround play or opportunity in a stock that you're invested in the long term, or it's a high quality company, then this is an opportunity. And I think that that's a better way to look at these pullbacks, is to not look at all the money that you've lost, but instead see them as what they are. That for the most part, the bull market continues climbing the wall of worry, and pullbacks are gifts to be able to average down or average into companies and stocks that are high quality, or that you have conviction in about a turnaround, and get that lower price. It's the one place where, and I think maybe this is a Peter Lynch or maybe it's a Warren Buffett quote, where the stock market's the only place where people run away from a discount. And that tends to be the case because fear is contagious. Fear does spread, but just look at some of these events that we looked at today, and one, of course, was fake. Look at previous times, like what Peter Lynch was saying, that were walls of worry that just seemed like no big of a deal, and put that into today's context. What are people worried about? Well, I mean, there's a few things always that we could be worried about, but instead invest in high-quality companies according to the risk tolerance and the amount of money that you're comfortable with that lets you sleep at night. And the real test is when you get these pullbacks, where I think maybe just in the very beginning of, if you can sleep at night comfortably and not worry, not be upset, not be afraid, then you've probably done the right amount of risk tolerance that you need. So anyway, let me know what you think in the comments. As far as these companies, now no cheating. If you skipped ahead, don't go back and play the game once you've seen those answers, but I'd love to see who actually nails these. I'm not sure that I would have actually gotten this right myself if I wasn't doing the game, just in full honesty. Let me know also what you think as far as the current market. Are we in the middle of a pullback, and how far down do you think it goes? What companies are you looking at averaging and buying into? I think all of the ones that I hold, I'd love to add more at certain levels. Anyway, thank you guys for watching, commenting, and subscribing. And until next time, happy investing.